Here's a question that breaks most people's brains. Which is riskier? Putting $10,000 in a safe savings account, earning 1% per year, or putting it in the stock market, where it could drop 20% in a bad year? The obvious answer is stocks are riskier, right? Wrong. Well, sort of. Because there's a hidden risk in safe investments that nobody warns you about. And it could quietly destroy your wealth over 30 years. Let me explain the golden rule of investing that changes everything. In investing, there's one rule that never breaks. Higher potential returns always come with higher risk. Lower risk always means lower returns. Think of it like a seesaw. You can't have high returns without accepting high risk. And if you want safety, you have to accept smaller gains. This isn't a suggestion, it's physics. It's how markets work. Here's why. If an investment offered high returns with zero risk, everyone would buy it. Demand would skyrocket, prices would go up, and returns would drop until the deal wasn't special anymore. The market forces balance. High reward requires high risk. Safety costs you growth. But here's the twist most people miss. There are different types of risk, and the safe option might actually be the dangerous one, depending on your timeline. Risk number 1, volatility risk, short-term danger. This is what most people think of as risk, the chance your investment drops in value tomorrow, next month, or next year. Stocks have high volatility risk. They can swing up or down 10%, 20%, even 50% in a single year. Bonds and savings accounts have low volatility risk. They're stable, predictable, boring. The fear, what if I need my money and the market is down? This risk matters if you need your money soon, within 1 to 5 years. Risk number 2, inflation risk, long-term danger. This is the invisible killer. Inflation risk is the chance that your money loses purchasing power over time because prices rise faster than your returns. Let's say you put $10,000 in a savings account earning 1% per year. In 30 years, you'll have about $13,500. Sounds good, right? But if inflation averages 3% per year, prices will have doubled. Your $13,500 will buy what $6,750 buys today. You saved your money and lost half its value. The fear, what if I play it safe and end up broke anyway? This risk matters if you're investing for the long term, 10, 20, 30 plus years. Let's break down common investments from safest to riskiest. Low risk, low return, good for short-term goals. Savings accounts / high interest savings. Return 0.5% to 5% per year, depending on rates. Risk almost none, government insured in most countries. Best for emergency funds, money you need within 1 to 2 years. Government bonds, US Treasuries, Canadian bonds, etc. Return 2% to 5% per year. Risk very low, governments rarely default. Best for conservative investors, money needed in 3 to 5 years. Corporate bonds, investment grade. Return 3% to 6% per year. Risk low to moderate. Companies can default, but stable companies rarely do. Best for income-focused investors, near retirees. Moderate risk, moderate return, balanced approach. Index funds / ETFs, diversified stocks. Return 7% to 10% average per year. Long-term. Risk moderate volatility, can drop 20 to 40% in bad years, but historically recovers. Best for long-term growth, retirement accounts, 10-plus year timelines. Real estate, primary home, REITs. Return 4% to 8% per year. Varies by location. Risk moderate. Property values fluctuate. Maintenance costs, liquidity issues. Best for long-term wealth building, diversification. High risk, high return, aggressive growth. Individual stocks. Return highly variable, minus 50% to plus 100% plus in a year. Risk high. Companies can fail. Prices swing wildly. Best for experienced investors, money you can afford to lose. Small portion of portfolio. Cryptocurrencies. Return extremely variable, minus 80% to plus 500% plus in a year. Risk very high, extreme volatility, regulatory uncertainty, no intrinsic value. Best for speculation only, tiny portion of portfolio if at all. Startup investments / venture capital. Return most fail, 90%, but winners can return 10 times to 100 times. Risk extreme, Most startups fail completely. Best for accredited investors, diversified portfolios, money you can lose. Here's the framework that makes this simple. In your 20s and 30s, take more risk. Why? You have 30 to 40 years until retirement. Short-term volatility doesn't matter because you have decades to recover from market crashes. Strategy: put 80 to 90% in stocks, index funds, ETFs. Keep 10 to 20% in bonds or cash for stability. Accept volatility. It's the price of long-term growth. Focus on growth, not safety. Example portfolio: 70% stock index funds, S&P 500 total market, 20% international stocks, 10% bonds or high-interest savings. The math: $10,000 at 8% for 30 years equals $100,627. At 2% equals $18,114. The difference is massive. In your 40s and 50s, balance risk and safety. Why? You still have 15 to 25 years to grow wealth, but you're closer to needing the money. Start shifting towards stability. Strategy: put 60 to 70% in stocks, put 30 to 40% in bonds and cash. Gradually reduce volatility risk as you approach retirement. Example portfolio: 60% stock index funds, 30% bond. A common rule: subtract your age from 110 or 120 to get your stock percentage. At 40, that's 70 to 80% stocks. At 50, it's 60 to 70%. In your 60s and beyond, prioritize safety. Why? You're living off this money now or soon. You can't afford a 40% market crash when you need to withdraw funds. Strategy: put 40 to 50% in stocks. Still need some growth to beat inflation. Put 50 to 60% in bonds, dividend stocks, and cash. Focus on income and preservation. Example portfolio: 40% dividend-paying stocks, 40% bonds, 20% cash for immediate needs. You're shifting from growth to don't lose it. Here's the number investors actually use to measure if risk is worth it. The Sharpe ratio, return above the risk-free rate, divided by volatility. Translation: how much extra return am I getting for each unit of risk I'm taking? A Sharpe ratio above 1 is good. Above 2 is excellent. Below 0.5 means you're taking too much risk for too little reward. You don't need to calculate this yourself, but understanding it helps you ask, is this investment worth the risk I'm taking? If an investment is volatile and has low returns, that's the worst combo. High risk should mean high potential return, or it's not worth it. So here's your takeaway. Safe investments aren't always safe. Inflation can quietly destroy them. Risky investments aren't always dangerous. Time can smooth out volatility. Match your risk to your timeline. Young equals more stocks. Older equals more bonds. Want a part 2 on exactly how to build a portfolio based on your age? Like actual fund names and percentages? Comment your age and tell me, are you playing it too safe or taking risks you can't afford? Let's figure it out together. Thanks for watching. Don't forget to like, share, and subscribe.